Good luck tracking the AI industries these days. It is a full-time job. Every day there's a new model, a new multi-billion-dollar deal, and another stock soaring. But of course, you can't ignore AI as an investor. You must understand it. And with a new industry like this, it's helpful to sit down and chart out exactly how it works. Who does what, who's paying who, and what businesses will actually turn into moneymakers. So today, I'm going to break it all down for you right here in this video. Along the way, I'll talk about a whole bunch of AI stocks, and I'll bring in an AI expert to help us make sense of it all. Let me start with the billion-dollar deals being thrown around every day. So OpenAI made a $300 billion deal to buy processing power from Oracle, and Oracle shares rose 36% in a day. Nvidia pledged to invest $100 billion into OpenAI as part of a plan to build 10 gigawatts of AI data centers. CoreWeave announced it added an additional $6.5 billion to its standing deal with OpenAI, and another one a week later for $14 billion with Meta. Shares of CoreWeave were up 32% in a month, and all of that I just listed happened in September alone. Now, under normal circumstances, deals with these many zeros would take weeks or months to hammer out, but the pace of activity in Silicon Valley is blistering, with deals worth hundreds of billions of dollars happening at what seems like an overnight pace. And what's also interesting is many of these deals come as a big surprise, and they upend strategies these companies have pursued for years. So for instance, Meta has developed its own LLM, and now it's spent billions in salaries for its own super intelligence research team. Plus, it spent tens of billions on its own infrastructure. But now we hear Mark Zuckerberg is in talks with Alphabet to use its Gemini model to improve Meta's ad business. Or take Microsoft, a major investor and supplier for OpenAI. It's made a huge bet on OpenAI, integrated its AI into Microsoft's Copilot product. But Microsoft just cut a deal with Anthropic to use its Claude AI in Office apps. So money and computing and intelligence are flying around every which way, and it practically takes a super intelligence to track it all at this point. That's where we're going to break it down today. So the stocks ripping higher on AI excitement do all sorts of different things. Some are extraordinarily profitable, and others are acting only to incinerate cash, at least for now. If you want to look at this, I break AI down into 4 layers: applications, foundational models, hyperscalers, and then hardware and infrastructure. Now, most people are the end users of AI. They're working at that application layer, so let's start there. Today, people use AI through things like Perplexity's Notebook and Cursor for coding, and of course the chatbots too, but I'll get to those in a second. These apps are built on top of foundational models made by the big AI companies. The AI apps collect money from subscription revenue and pay the model creators for access to intelligence. And these app companies aren't even close to profitable yet. Since AI eats up so much costly compute, each action from a user actually loses these companies more money. They have a long way to go until profitability. And you can extend this assumption to the popular chatbots like OpenAI's ChatGPT, Google Gemini, and Anthropic's Claude. So yes, these chatbots work on the application layer. They are the product built on top of the foundational model. In the case of these, it just so happens that the AI product is built by the same company that has built the foundational model. And you'll see as we go along, many of these companies in AI straddle several of these layers. So if we could separate ChatGPT from OpenAI, it's likely that ChatGPT would pay OpenAI more than it takes in revenue. Same goes for Claude and Gemini. The application layer, it just is not profitable yet. But if you step down to the next layer, the foundational models, they're not really making money either. Look at what I consider the 5 big models: OpenAI's ChatGPT, Anthropic's Claude, AI's Grok, Alphabet's Gemini, and Meta's Llama. These companies carry massive compute costs. They pay not just to serve answers to model users, which is known as inference compute, but they spend hundreds of millions of dollars on training runs to improve the models. So these companies don't really provide financials, but we can tell that building models is a money pit. Reuters reports OpenAI earned $4.3 billion of revenue in the first half of 2025, but posted a loss of about $2.5 billion. Anthropic's probably in the same boat. Elon Musk's XAI is burning about $1 billion per month. And if you could break them out, the numbers for Alphabet and Meta would probably look about the same. So these foundational models simply cost way too much to build and run. But those costs are the revenue that gets sent down to the next layer, the hyperscalers. And all the money is being spent on computing power. The hyperscalers are the companies building and running massive data centers, which they rent out to train and run models. So prior to the AI boom, the three biggest hyperscalers were Amazon, Microsoft, and Alphabet in that order. And now as time has gone on, the market has grown. There are now specialty cloud companies like CoreWeave that cater to AI companies. Oracle now is expanding their compute capacity to provide services for OpenAI. And then, of course, the model builders are also becoming their own hyperscalers. Meta, OpenAI, XAI, all building data centers of their own. And this compute part is where the profits start to show. The hyperscalers earn outstanding margins by renting out traditional compute. They have a business with profitable unit economics, we call it. That means they can sell compute for more than it costs them. But they are investing all those profits right back into the business for the future. You can see this when you look at the financials of a pure play like CoreWeave. The company has positive cash flow from operations, but negative free cash flow after you consider their capital spending. So profitable now, but plowing those profits into the future. And speaking of profits from AI, I want to point out that Stansberry Research is working at the cutting edge of AI, using it to create profits for investors just like you. In our case, we just launched a fully quantitative system to select the best businesses in the market and combine them into an AI-driven portfolio that any investor can follow. It's built on the proven fundamentals of finance paired with AI. The back-tested results are incredible, beating the S&P 500, gold, a 60-40 portfolio, even Warren Buffett's Berkshire Hathaway. And you can learn all about it at StansberryAISystem.com right now. There's a link in the description. But let me get back to the AI industry for now. The biggest boom really has happened where those hyperscalers are spending. And that's on the next layer, the hardware providers. That's Nvidia for GPUs, Cisco for networking, and it spreads to all kinds of building and infrastructure companies. Much of the AI spend is ending up in companies that make wiring, cooling, and electrical power for data centers. And these companies at this layer are in full-on boom mode, making high revenue, earning big profits, and their stocks show it. You can see this in HVAC company Comfort Fix, power generation Constellation Energy, and Corning, which does fiber optics, Amphenol, which does high-speed interconnects. These picks and shovels plays on AI are still booming. But if you step back, take the 10,000-foot view, you can see that AI is not paying for itself. It's clear that the revenue from AI end users is nowhere near the spending on data centers. So the money isn't flowing through the layers from the top down. It still needs funding to come into the ecosystem at various sources. And each layer is getting this funding from different sources. And as an investor, you need to understand where the money's coming from. So if you look at the top, the losses for AI applications are being funded mostly by venture capital. If you move down to the foundational models, it starts to split. For private firms like OpenAI and XAI, that money's coming from venture capital. But for Alphabet, Meta, the big Mag 7 companies, the massive free cash flows from their advertising businesses are funding their AI projects. You go and look at the hyperscalers, it's also mixed. The huge tech companies can fuel much of their own growth with cash flows, but they are also borrowing. So this is where debt comes into the picture. So despite having $47 billion in cash on hand, this summer Meta sought to raise $26 billion in private debt. CoreWeave has $14 billion in private debt, sent to get its $3 billion in revenue. And the burgeoning private credit industry is financing hundreds of billions of AI spend. UBS Global Research reports that private lending to the tech sector reached $450 billion earlier this year, up $100 billion from the prior year. So there's still no value being created by AI. It's only supported by money from outside investors and lenders. But that is not necessarily a bad thing. This is how it goes with young industries and new technologies. The business model's not there yet, but that doesn't mean it won't develop. That is what is great about a modern capitalist economy. We can fund progress without an immediate reward and end up living in a more productive and richer world down the line. So the question you have to ask is, how long can the money keep flowing into AI? And I can tell you that AI spending has a very long runway. I have to admit, early on, I thought we only had a few quarters maybe before we needed to see significant AI revenue before investors started to sour on the idea. But now I believe that markets can keep supporting AI spend for much longer. And here is exactly why. Most of the spending decisions and the capital come from the gigantic tech companies, and they are all in. Microsoft, Alphabet, Meta, they see AI as an existential threat to their existing business, and they will not cede any ground at all to their competitors. Microsoft CEO Satya Nadella said he's haunted by the thought of Microsoft not surviving into the AI era. Mark Zuckerberg of Meta said he'd rather end up misspending a couple $100 billion than miss out on AI. And Alphabet founder Larry Page has reportedly told employees he would rather go bankrupt than lose the AI race. And for now, the share prices of AI companies show that there's no reservations yet about this spending stopping just yet. However, I need to point out that the AI ecosystem has gotten more complicated and circular. AI companies with capital are pouring it right back into other layers of the AI stack. So as noted earlier, Nvidia is investing $100 billion into OpenAI. OpenAI will use that investment to buy chips from Nvidia. And Nvidia's done the same thing with other companies. It owns more than 6% of CoreWeave, which uses Nvidia chips to build its data centers. So these are roundabout deals in which suppliers are investing back into their customers who are using it to buy more from the supplier. So this circular nature of AI spending does create greater risk, right? This feedback loop of AI spending suggests that any crash will be swift and severe. So if you think about an industry with a traditional value chain, changes in the business sort of scale linearly to asset values, right? If we take the business prospects for Walmart and they improve a little bit, the stock goes up a little bit. But when you have a circular system, that makes it, non-linear, chaotic even, right? Small changes can lead to bigger reactions. So the cycle is driving all of AI higher today. If faith in the AI future falters, the whole thing can fall apart. But thanks to the almost religious belief in AI from Silicon Valley's tech CEOs, the spending can run for a long, long time. So that is what you need to watch. And if you want to invest in AI like everybody does these days, you really need to understand how the industry works. That's why I brought in Josh Baylin. Josh is here at Stansberry Research. He's exactly the kind of person you want to hear from on this topics. He worked for one of the biggest and best hedge funds in the world. He ran his own quant hedge fund, and then he spent more than a decade working in tech with AI, robotics, wearables, and so much more. So, Josh, you know this stuff better than me. What am I missing here in the AI story?
Look, I think you've captured sort of the circular nature of the ecosystem at this point. But there really are, I guess, what I would refer to as like three constraint layers that sort of amplify both the risk and the opportunity in the space. Okay, so first, and this sort of underscores how the hyperscalers have been spending, right? Initially, they were spending on chips, right? They had to lock down Nvidia chips. And at this point, the bottleneck is really shifting from that chip capacity to power, right? Data centers need massive amounts of electrical capacity, and the traditional grid can't really keep up, right? And so you're even hearing anecdotally that people's power bills are going up because of this incremental data center demand. We're even seeing deals out there in the market where AI companies are buying power plants or investing directly in power generation companies because they know that this is now sort of the new constraint. And so what this really does is it creates kind of an ancillary investment thesis around electrical infrastructure, transformers, grid modernization, more efficient power transformation within the data centers, right? Cabling, chips, et cetera. And so that's sort of one constraint, right? I think the second constraint, and you didn't really touch on this, but it is that data quality is actually becoming a moat for some of those foundational model builders, right? OpenAI has already cut a big deal with Reddit for millions of dollars, right, for training, and it's not really the compute there. It's the content, right? It's the underlying content that makes these models smart, right? Stack Overflow, same thing, New York Times. And so all of a sudden, these proprietary data sets, these good data sets that allow for high-level training of these foundational models is really kind of going to be a competitive differentiator. And this is really the third, and we've written about this and we've talked about this, but everything we've primarily talked about has been about the data center itself. But this is really crucial for investors. Edge infrastructure really becomes the next battleground for these hyperscalers, and frankly, a huge opportunity for investors, right? Because AI can't just run in data centers, right? It needs to run locally in cars, factories, cell phones, AirPods, right? All of these devices and this proliferation of new AI-enabled devices actually create sort of a new opportunity that investors can take advantage of, right? So it's compute infrastructure for basically all of these little devices that are starting to proliferate, right? And so in a sense, again, back to your original question, the spend makes sense and the circular nature of it is kind of okay. And I know we talked about this briefly before, but in a way, this direct spend at such high levels is actually a way for some of these foundational models that do rely on venture capital or debt financing to almost eliminate those expenses and that friction of adding a third-party financier, and they're just going direct to the supplier to cut the deal. So in a way, they're almost leveraging the strong financial position of some of the big suppliers like an Nvidia to cut direct deals and eliminate some of the unnecessary financial transactions.
Yeah, it's interesting from a financial perspective. You think of that as adding risk, the circular nature, but they're actually kind of de-risking by locking in their suppliers and locking in, coming over these bottlenecks that rather than have their business fall apart when they don't have what they need. So it could work out in the industry's favor. Like I said, it sounds like a risk, but if you dig in, it's still all pretty bullish. And so, Josh, you're plugged into the tech industry. You know lots of people in both finance and Silicon Valley. When you talk to people, do you get any sense that the people making these spending decisions are starting to have doubts or they're getting cost conscious? Or is it still, the mood in the room is still full speed ahead?
So, look, we started having these discussions about an AI boom or an AI bubble back in April or May, Matt. And I told you back then that the canary in the coal mine would be when these hyperscalers start to pull back on spending, right? Announce that they've built too much or they're going to pull CapEx back. 6 months later, we haven't seen it, right? And so to some extent, it still is full speed ahead. But as I mentioned before, it's really buy everything we can to secure those critical constraint points, right? And so when you talk about some of these mega deals, right, these really, to my earlier point, this isn't panic spending, right? These are strategic moves to lock up scarce resources, power capacity, chip allocation, data center real estate, cooling, cabling. There just isn't enough to go around right now. And so I think in some ways, when you're seeing, you were talking earlier about some of the cross-pollination where, Meta is using Google's models and Apple are using Google's models and Anthropic is actually collaborating with OpenAI and vice versa. This isn't indecision. This is actually, to some extent, the spreading of risk, diversification. And, I think folks are starting to understand that it's going to be difficult for one winner to emerge from some of these foundational models. And so they're really hedging their bets, right? And so, you mentioned CoreWeave. I think the biggest indication that spending hasn't slowed and some of the bigger hyperscalers and spenders haven't decided to spend slow spending is that a CoreWeave has a very significant debt burden that would traditionally worry certain financial markets, certainly, and that just does not seem to be the case just yet. And so we continue to spend. Without question, I'm going to tell you the exact same thing I told you in May and in May, June, July, even August. When you hear one of these larger companies, a Meta, an Amazon, beginning to pull back on spend, that is when we need to be very cautious about what they're pulling back on and how it impacts. But as of right now, back to your earlier points that Zuckerberg made, Ellison made, certain folks at Google. This isn't a bet that AI is going to be big. We know that. They are betting that if they don't invest now, that is the existential risk. And so that's really a higher bar for stopping spend. And so, yeah, it is full steam ahead, but, again, very strategically at the moment.
Okay, so if an investor is looking at the stock market now, you've talked about the bottlenecks and investing bottlenecks are where the opportunities are, which is always fun to point out. Where along this ecosystem do you think investors should be making bets today? Are we still at picks and shovels? Are there applications that are actually going to start turning profitable? What specific stocks should people be looking at?
Well, I think you mentioned some of the picks and shovels opportunities, right, within those constraint points. I've written pretty extensively about Micron. That's obviously, within data centers and even at the edge, high bandwidth memory is a scarce resource, right? Every AI player is going to need them both in data centers and at the edge. And so you've seen Micron and some other memory providers act pretty well. Same thing, we talked about power, power and cooling within data centers, a Vertiv has been something where, yeah, the stock has ripped, but there aren't that many competitors to something like this. So when you find these, constraint driven opportunities, the Vertivs, the Microns, those are good places. I think, the other kind of category that I would sort of put this in are the, let's call it profitability now bucket, right? Where, the oracles of the world, they do have stable cash flows from other businesses. They're paying a dividend. Yeah, the stock has worked. But, again, until there's an indication that business is, the trends are changing or there's some type of negative catalyst, I think some of these, quote, profitability now opportunities will remain. And, I think the third is, again, as we kind of get more and more edge expansion, some other more traditional, localized, be it semiconductor plays or even data center plays, will continue to work. So I've highlighted Qualcomm in the past as a potential winner here as the proliferation of devices grows. Broadcom obviously, continues to work. In short, I really do want some portion of an investor's portfolio allocated to these opportunities. The returns are there. They're not without risk, but again, spending continues, and I really do think that returns can continue. So, back to the first point that you made, right? This circular funding mechanism, it's not a bug, it's a feature of this, right? It's actually how the ecosystem is showing some maturity. It doesn't mean that it doesn't come with some risk and some peril, but again, I think this really does create more certainty that revenues amongst big players continues, support amongst the ecosystem continues, and subsequently certain stocks will continue to work from here.
All right. Well, that's great, Josh. Thank you so much for breaking this down. It's an incredible new industry being built. and there's so much to learn. Glad we can learn it from you. There's a lot of profit opportunity here. And people, before you go, don't forget that Josh is just one of the folks we have working here at Stansberry Research. In fact, to build our new quantitative AI-based investing system, we enlisted experts in quantitative finance, computer science, even a PhD in astrophysics. If you want to see how to build a simple but profitable AI portfolio with AI helping you make the stock selection, go and visit stansberryaisystem.com to get the whole story. You won't be disappointed. As always, like and subscribe here on YouTube, and I will be back next week.